What is going on today, YouTube? Today we're going to talk about why investors lose money. This is the number one reason, easiest way to explain this. Now, this depends on what kind of investor you are. If you are an investor that just looks at price, if you are an investor that just looks at price fluctuation, this trap will get you every time that I'm going to explain this video. But on the other hand, if you are an investor like Warren Buffett and you don't worry about what the price does day in and day out, this will never happen to you. So the number one reason why investors lose money is because all they do is they look at the price action. I know this is an ETF that I'm going to explain this with, but I'll show you through a stock in a second too. So they watch this ETF right now. This is the best example I've seen in a while. You watch it for a while, it's all the way down to 488, and you're watching it, it goes up, flattens out, it goes up, and then you have this solid period of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 days of this ETF doing nothing but going up. That's the trap people get into right there. They see this and they're like, well, it just keeps on going up. I should have got in back here. I missed out on, 160% gain. So they decide they're going to get in near the top or even at the top. But they decide they get in here. They get in, expect it to go up forever, and it goes up 50%. If they're lucky enough to cash out at that time, would have been great. But if they're sitting where they are today, they are dead even. And who knows where this is going to go for the future. It could go right back down to where it was trading before. So do not just look at the price action and see this thing going up and just buy in. That's why first-time investors, they try to pick their own stocks. They buy when they see stuff like this. Penny stocks are fantastic for this. They do this all the time. The investor buys the penny stock up here because he thinks he can outsmart everyone else in the world, and then he loses his entire position because it goes the whole way back down to, say, 488 where it was trading before. Just to put in perspective what that is, say you bought at 22.26, goes back down to 488, that's a 77% loss on the position you took. So even DRN, or not DRN, DRV. DRV does the same thing. Goes up and up and up and up, and then could come back down the whole way to 828. I believe Oil U. No, it must have been Oil D. Oil D, same thing. Up and up and up. Comes down. Don't just look at these charts and think, wow, this thing's been going up for so long, I need to get in now. Make sure you understand what you're investing in if you're an investor. So, for instance, we'll go to Tilray. Tilray is a medical cannabis company. It's one of the largest producers now. And if you're watching the news or anything online, reading anything online, a lot of people are getting big on these medical marijuana stocks. They think they're going to be the future. They think that's what is going to make them tons and tons of money, which they could be true. Who knows? They could very well be right. But the same thing happens with this. I made a video a little while back, and I just want to show you what has actually happened. So when I made my video a while back, I wanted to tell people this was a trap. It was a trap stock. Like always, it goes up like crazy. It goes up from $20 to $300. So roughly, it goes up 785% in 44 days. That's insane. It's unheard of. You can't expect to have that kind of growth to continue going on. So my video was just trying to say, don't buy up in here because it's gonna come back down. And look, it did. I'll put the link to that other video at the end of the video, and I'll put it in the description below if you want to check it out. But say you bought in here, say you're unlucky, bought in here. First day, yeah, you were all pumped. It went up another 50%. You're like, wow, I made the right choice. It's going to keep on going. As of December 28th, this thing's down 52% from where you were. Now, no, there's no say that this thing can't just go right back up again. But most likely, it was trading in here for so long. But most likely, since it was trading around, it opened. This stock isn't that old. It's a newer stock. It's a newer company. It was trading this $20 range. That's probably where it belongs. It probably does not belong. It does not belong anywhere near here. Probably doesn't even belong in the $75 range. They don't even make a profit yet. There's their earnings. On 828, minus 17 cents per share. Yes, they're getting better, but they are not even a profitable company, And that's why the stock market, it's all on hype, it's all on manipulation, it's all on, I don't really want to say manipulation, but it's all on what people think a company is going to go to. If they think it's going to be the biggest in the world, they think it's going to be the biggest in the industry, it makes the stock price go crazy. For instance, Amazon. Everyone always thinks, we're going to look at the lifelong chart of this since it's been around for a while. Everyone has a lot of faith in this company, and its PE ratio as of December 28th on Friday. Amazon's PE ratio is 82. What that means is their PE ratio. The PE ratio is a price to earnings ratio, trading at 82 times. So their market capitalization makes up for 82 times what they are earning. Or easier way to look at it, their current price on that Friday is 82 times what they are earning per share. So their price to earnings ratio is absolutely absurd. To get an idea of what your price to earnings ratios should be, you need to look at the entire sector. So for instance, Amazon. You would look at other companies like JD.com or Alibaba, companies that do essentially the same thing. I know Amazon is way above and beyond both of those companies I just mentioned, but they still do the same thing. You try to compare what their PE ratio is, and you get that of the sector. So if you're looking at marijuana companies, you want to invest in them. You look at the PE ratio of the entire sector. If they are all in the ballpark range, then you see one way higher or way lower, that can tell you if it's relevant. You can't do this cross sectors. You can only do it like you break down like medical industry, you break down the e-commerce, you break down to auto manufacturers, you break down the airplanes. You have to break it down to the sector and compare their PE ratios. So that's it for the video. I just want to show you what the number one mistake is that makes investors lose money. If you like this video and it taught you something, leave a like on the video. Helps me know I'm making good content. If you got any questions, leave a comment below. And if you like videos like this, subscribe to my channel. And I will see you in the next video.